Global finance, topic 5. Valuation, copyright Lou Gaddis. All right. So this topic is really, it's nothing new. Actually, every example you're about to see I gave you last year, but you probably forgot everything, besides Brian. But the rest of you probably forgot everything. And so just review, what is NPV? How do I get a WACC? What if the capital structure is a little bit different? And then, so it's just probably take about an hour to kind of review that. And then we're going to take a little break. And then we'll come back and say, okay, how do I adjust that process for an international project? All right, they have different risks, I think, and they have different currencies. How do I kind of mix all that up and get an NPV in dollars for a project that's all in rupee? Wow. You okay?
We're not doing NPVs, that's it.
I'm sorry. Nice. Keep launching the wrong one here. Let's get. Come on. Should I start over? Are you okay? Guess I get to start that over.
We're already on topic 6.
All right. Topic 4, domestic capital budgeting. All right. So again, just to review, what are free cash flows? What's NPV? What's the discount rate? What's WACC? What's cost of equity? What's cost of debt? All right. Does anyone remember any of that stuff? That's okay. So the basic idea for this is, in order to go ahead with a project, and I know the marketing people and supply chain people, you think you own the universe, but at some point you're going to have to ask a finance weenie for some money. All right. And eventually you got to justify your project based on the financials. All right, the main tool of justifying a project based on financials is calculating an NPV, a net present value. And all that is, you take all the cash flows over time, adjust for the time value of money, meaning that $1 tomorrow is worth less than $1 today, and also applying a discount rate. A discount rate is the rate that you apply to figure out how much $1 tomorrow is worth. And the idea is, the riskier the cash flow, the higher rate of return you would demand. All right, so if I were going to buy, say, a U.S. Treasury bond for 1 year, maybe I only demand a 1% interest because it's really safe. All right, but if I want to, get a Kmart bond, I want to demand a 6% return. So when Kmart promises to give me $100 next year, I'm only going to pay $94 for it. Right? And that's the idea, that the riskier the cash flow, the more uncertain that cash flow, the less I'll pay for it today. How that manifests itself is we just have a higher discount rate. All right, so that's the big picture of what we're doing here. So the formula, for those of you who love formulas, it's the sum from the first cash flow to the last cash flow of all the free cash flows discounted at some rate K. Why we use K, I don't know. We just use K to mean cost of capital. And you also subtract off any initial cash flow. Call that FCF0. All right, so that's the NPV. And the way this NPV works is, all it needs to be is greater than 0. If the NPV is equal to 0, what we're saying is that project is kind of fairly priced. You can do it, you can not do it, doesn't create value, doesn't destroy value, you're getting fair compensation for your investment. All right, if the NPV is greater than 0, what that means is you're creating value for your organization. Your stock price should go up. All right. Another way of thinking about it is, if the NPV is greater than 0, the return on the project is greater than the cost to finance the project. All right. Another way of thinking about it. So the cash flows. All right. In finance, we don't use accounting profits. All right. We use cash flows. Right. I can't spend profits. I spend cash. So we always focus on free cash flows. The cash flows we're going to use for this class are the ones most used in organizations. Are called free cash flows to the firm. Now, when I say that, there's a lot of different things that are called free cash flows. So there's several different measures of free cash flows. Yeah.
I'm sorry. From the last slide,
Yeah.
What is that K stand for?
That is the discount rate or the cost of capital. And usually it's going to be the WACC, weighted average cost of capital. So it's kind of the rate of return that you demand from that cash flow. All right, so for example, again, back to the example I was talking about before. What if the U.S. government promises to pay you $100 1 year from now for a U.S. Treasury bond? And you might say, you know what, that's about the safest investment in the world. Inflation's about less than 1%. I only want a 1% return. So I'm going to use a cost of capital of 1%. So what that says is I will pay $99 for that investment. All right, that's the promised cash flow. If that bond actually cost me $99, all right, so if it actually cost me $99, what I'd say is the NPV of buying that treasury is 0. I'm getting a fair rate of return. I'm getting a 1% return. All right, so that's kind of the idea of NPV. So what cash flows to use? We're going to use called free cash flows to the firm, or free cash flows from the firm, or for the firm. And what they are cash flows that are generated by the business that are available to pay all the capital providers. So when I say capital providers, firms borrow money from banks, they issue bonds, and they issue stock. Those are their capital providers. Debt holders, right? Bond holders and loan banks, and equity holders. Equity holders are the people that own the stock. All right. So what we want to do to capture the cash flows, we want the cash flows which are available to pay the interest payments on the bonds, to pay a dividend, to retire a bond, to pay off the loans. We want to get the cash flows available to pay those capital providers. All right, and how do we get these free cash flows to the firm? We usually start with profits, but then we have to make some adjustments, accounting profits. All right, so the first thing we're going to do is we're going to take, say, our accounting operating profit. It's called EBIT, earnings before interest and tax. EBIT, earnings before interest and tax. All right, so that'll be just basically revenues minus expenses. All right, we'll then take the tax out. All right, sometimes that's called net operating profit after tax, NOPAT. All right, so that's this is still an accounting number. However, what we're going to do is we're going to add back depreciation. Because in this, there was an expense item in there for, say, depreciation expense from something I bought 10 years ago. Well, that's not a cash flow, right? It's a recognition of a cash flow 10 years ago. So what we're going to do is we're going to add that back. But then we do want to capture the fact that the business has to buy new buildings and buy new cars and buy new printers and things like that. So we want to subtract out the actual CapEx in any given year. Then also subtract out any working capital. Change is what we say is change in net working capital. So if you had to build up some inventory a little bit this year and you didn't get to sell the items, right, because that's why it's still inventory, you had to capture that as a cost. If you had some sales and they count as revenue, so they're in here, right, sales always show up as revenue, but you actually never collected it from the customer. You need to subtract that out because it wasn't cash. So that's how we go from profits to cash. We make those adjustments. All right. So that's how we get to the free cash flows, the numerator of that NPV equation. We're going to do some examples in a minute. And then the question is, well, how do we get the cost of capital? All right, what discount rate should we use? The standard one to use is the WACC, the weighted average cost of capital. And what all that is you look at your security holders, usually your bond holders and your stockholders, and you try to figure out what rate of return do they demand. All right? And then you just take a weighted average of the returns that the debt holders demand and the equity holders demand. You take a weighted average, you say, well, that's the cost of me financing a new project. Therefore, I'm going to use that as my discount rate. And if I use that as my discount rate, what it means is when there's an NPV greater than 0, the returns of the investment are greater than the actual financing cost of it, right? If I'm borrowing money at 10% and getting a project that earns 9, I'm going to get a negative NPV. And that's all the NPV is doing in this case. All right. So I take the return that shareholders demand. I'll call that KE, cost of equity. I take the return that the bondholders demand, I'll call that cost of debt, and I multiply times the percentage of equity financing and the percentage of debt financing. Except one little adjustment. The U.S. government gives a deal on debt. you can subtract off any interest payments before calculating tax. Right? It's like a like when we do our personal taxes, we can subtract off our home mortgage interest first. Well, the U.S. government is subsidizing the use of debt by American corporations by allowing you to subtract it before you pay your taxes. So we take the after-tax cost of debt and the pre-tax cost of equity, and we take the weighted average. That's how much it costs in percentage terms to raise capital for your firm. Okay? Kind of some of the cobwebs coming off. Does this kind of sound familiar a little bit? All right. Now, cost of debt, that's relatively easy. You can just say, well, I just issued a bond last month, and when I issued it, the investors wanted a 6% return. That's easy. Or go to your bank loans and see what they are. So we'll talk. That's an easy one. The tough one is this. When you buy a share of stock, there is no promise of a cash flow ever. There's no rate of return associated with it. When you buy a share of stock, you get a promise of basically two things. If the firm pays a dividend, you'll get it, but it doesn't have to pay a dividend. And you're allowed to vote on certain things. That's it. That's all you get from a share of stock. There's no rate of return. There's no promised cash flow. A lot of firms pay zero dividends forever. So that's all you get. So there is no place to look to see what rate of return your equity holders demand. We have to create models. And the default model is the CAPM. You remember that name, CAPM? The Capital Asset Pricing Model, developed about 40 years ago. And it's the best model. Well, it's just what we use. I don't know if I guess by default it's the best model because it's the only model we really use. And what that model says is the cost of equity, the return you should get from a share of this company has to at least give you the risk-free rate. Otherwise, why would you buy a risky share if it doesn't give you the same thing as a long-term treasury? That's the number one thing. It's got to at least give you a risk-free rate. Plus a compensation for risk. Well, how do I do compensation for risk? Well, easy. This is the measure of risk. So this is the amount of risk. This is the compensation per unit of risk. So again, let's kind of rehash. What return should you get on a share of Google? Well, you better get the risk-free rate. Okay. Plus a compensation for risk. How do I measure it? Tell me how many units of risk it has, and tell me how much you get paid for each unit of risk. So how we measure units of risk in finance is generally something called beta. All right, what beta does, you generally calculate that historically and say how does the returns in this stock historically behave relative to the overall market? And if that calculation turns out to be 1, that means it's 1 unit of risk. It also means it has about the same risk as the market. This compensation per unit of risk is called the market risk premium. And we usually measure that historically, saying over the last 100 years, the U.S. stock market has returned about 5% or 6% over treasuries. So if the beta of the firm is 1, and say the risk-free rate is 2, and historically, the U.S. stock market gives you, say, 5% above long-term treasuries. You could say that this stock better give you 7%. Because I'll get 2% from treasuries. It has the same risk of the market, and the market gives me about 5% over treasuries. All right, now, the only difference is if the beta is 2, well, you better get 2 plus 2 times 5, or 12%. So the trick is, what is the actual beta, and what is the market risk premium? And no one knows the answer to either of those things. We think the market risk premium is probably between 4 and 7%, depending on what interval you measured it on. And betas are flipping all over the time. We measured last year's beta versus the year before, so it's always a guesstimate of what beta is. But I'll show you a little bit of that. Yeah.
Just going back, for private firms that have no public holdings, we're technically WACC just in cost.
No, we would actually, so good question. So you have a private firm, maybe has some debt outstanding, but has no equity. but you wanted to get the weighted average cost of capital. What you could do, or maybe let's say make it a little bit easier. Let's just say having no equity is weird. You have to have some equity, right? You can't have a firm that's all debt. You own some equity. So let's say a firm it's private. There's no stock, right? So you're private firm. You have equity. You just don't have stock. You have the ownership. What I would do, and this might be some cobwebs from last year. First of all, I would determine what business is my business in. All right, and say that your business is, I don't know, someone makes something up. I don't know. It's a coffee shop. You own a little coffee shop in your little town. You got this little hipster coffee shop working, right? And you say, well, what rate of return should I demand for if I were to sell the firm for my equity stake? One thing I could do is steal Starbucks beta and say, you know what, Starbucks beta must reflect coffee risk. Yeah, and we're going to get that in a minute. So I don't necessarily have to have a stock. I could have a proxy. A proxy for coffee risk is Starbucks or maybe Dunkin' Donuts or someone else or another firm. So you try to find a firm that kind of looks like your business and just calculate their beta and then you adjust it for your capital structure. So we'll do that in a minute. Is that okay? Sure. So this is the kind of the longer formula of WACC. What is WACC? It's the percent of equity times the cost of equity. What's the cost of equity? The CAPM risk-free rate plus beta times market risk premium. Percentage debt times the after-tax cost of debt. All right. Where do I get KD? Well, if you just issued a bond yesterday, go see what rate of return that bond earns. If you issued a bond for $100 and someone bought it at 94, that's a kind of a 6% yield. Just use that. You could use the actual interest expense. Say if you're doing it for a public firm and you're looking at the financial statements, you can actually look at interest expense. I don't tend to like that because there's always kind of some sweetheart deals with financing and maybe it's short term, it's going to roll over next month. So I generally don't use that. What I generally use is this method. I don't tend to use that. This method here. Oh yeah.
It's something that I forgot. So for taxes purposes, the U.S. government lets you take out the debt before paying taxes?
Yes. Yeah, so the government's subsidizing debt. And so if the government wanted firms to delever, they should just take out that clause and not allow them to claim interest.
So if you take a mega loan before the year end, you could save taxes?
Whatever interest expense you paid in that year, any interest expense. Yeah, not the payment of debt, not retiring the loan, just the interest expense.
Yeah.
It's just like your house. You get to subtract mortgage interest, but not the actual payment of the loan. All right? Is that good? All right. Here's the general method I use for usually public companies is if I can look at Walmart and they'll have hundreds of bonds outstanding, different yields based on short-term versus long-term, and some are callable versus non-callable, and some are convertible to stock and not convertible, and so all these weird terms. So what I generally use is this credit spread method. All right, I'm looking at a firm and I know that they're a BBB rated industrial firm. BBB rated industrial. So based on the risk of their business, this S&P or Moody's giving them a rating of BBB. And then I have lots of data about other BBB industrial firms. And what I could probably find out is BBB industrials generally have rates that are 3% above treasuries. Let's call it credit spread. I'll just take that credit spread and I'll add it to the treasury rate. I'll call that my cost of debt. That's the generally preferred method. It's a lot more stable, not dependent on individual bonds or loans. All right. So here's a silly example that I gave you a year ago. Actually, I wrote this before Apple actually did the mini iPad, or whatever they call it. So Apple's going to launch a mini iPad, right? And it's going to cost $500 million today, expense today to kind of launch this project. So that's my first cash flow. Let me change colors. Oh, maybe I'm not allowed to. So I'm going to take my $500. That's the first thing. That's the only I don't have to worry about discounting because that's $500 today. Then it's going to generate EBIT of 400 million per year, depreciation of 80 million a year, and CapEx of 75 million a year, and working capital, incremental working capital of 50. So what I'm going to do is take that 400 and get after-tax EBIT. So that's what, 240 after-tax EBIT. I'm going to subtract CapEx, subtract working capital, and add back depreciation. That project is going to generate 195 a year in cash flows. All right, so that's where I got all the cash flows. Now I need to get a discount rate. And I'm just going to use the firm's WACC, Apple's WACC. Now the justification for using the WACC is this is right down their wheelhouse, right? This is exactly the business they're in, tech gadget business. So let me just use their WACC. And they're going to finance it the same way as they finance all their other projects. So I'm going to put in my risk-free rate. I'm going to get the firm beta times the market risk premium and say, you know what? Shareholders of Apple demand 9.5%. I'm going to get their debt spread of 2% added to the risk-free rate of 3 and say, well, bondholders, they want 5. And then I'll just take a weighted average, 9% of 9.5 or 90% of 9.5 and 10% of the after-tax cost of debt. That's the cost of Apple raising money to finance this project, 8.85%. And I'll use that as my discount rate for the first year, second year, and third year. And it turns out to be negative. All right. What that means is that project's return must have been less than 885. Maybe it was like 850. I can figure that out, but I don't feel like doing that now. All it's telling you is you're not even covering the cost of raising the capital. So you should not do the project. Yeah. Natasha.
You always go in that order, FCA, WACC, how do you know which one to use?
So my general formula is just going to be the NPV. It's just going to be the sum of the initial cash flow. Well, I should just say there's no sum there. It's just minus the initial cash flow. That's the 500. Plus the sum of all the future cash flows at 1 plus the k to the t power. So this is the first cash flow. I'm sorry, the cash flow today, cash flow next year, 2 years from now, 3 years from now. So I'm just going to take the present value of all future cash flows. This project only has 4 cash flows, 1 today, and then 1, 2, and 3 years from now. Is that?
Okay, so why did you, I get it now, but why did you start with FCA first?
Oh, I just need to get this number, this numerator. So I didn't have to start with that. I could have started with the WACC, right? But I just
to get those things that
right. So the 2 pieces of information, I need this number and I need this denominator. So I just chose to get the free cash flow. But yeah, there's no reason. Yeah. Okay, we good? All right, so that's pretty easy. Problems. What if Apple wants to get in the cable business? Well, they're not currently in the cable business. Well, why couldn't they just use their own WACC? Well, their WACC is basically what their current shareholders and debt holders demand from them for being in the tech gadget industry. Right? If they want to get into the cable industry, that's a different risk. So I just can't use their existing WACC. It doesn't reflect that risk. So we're going to do this, and hopefully this looks a little familiar. We're going to maybe de-lever another firm's beta and re-lever it for Apple's capital structure. But we'll do 2 steps, right? Let's first just say, well, let's stay in the tech business. Let's just have a different capital structure. I know Apple is about 90% equity, 10% debt. But for whatever reason, you want to finance it a little bit differently. All right, if you want to finance it a little bit differently, you can't use Apple's current WACC, their current debt and equity positions. You always have to reflect the debt and equity of the new project. So in that case, if they want to stay in the tech business, but just finance it a little bit differently, I'm going to do a little financial engineering here. Take their beta that you just measured using whatever method we did, it's probably some regression from past data. We're going to de-lever it all right, by dividing by 1 plus the after-tax debt-to-equity ratio. Is this starting to make a little sound familiar? So the idea is, why would a stock beta be higher or lower? So the first reason is if a firm has lots of debt, right? A firm has tons of debt. It's riskier, right? There's more chances you're not going to get your money. So if a firm has lots of debt, it must have a higher beta. So two firms are in the coffee industry. Right? I didn't actually stand up for him. I just got bored. Actually, I did. Then I thought, like, you guys are going to think I'm kind of shallow. But if two firms both have coffee shops in your neighborhood, right? But one has lots of debt and one has no debt. Like, as a shareholder, well, the one with no debts can't go bankrupt. Right? Like from last year, no duh moment. A firm that has no debt can't go bankrupt. It's kind of obvious, right? But a firm that has no debt can't go bankrupt. It must be safer. So how can these two businesses have the same risk? They're across the street from each other. One is riskier because of debt. Well, how we kind of reflect that risk in the beta and cap M is we can take, say, the firms, say the firm with lots of debt. We can just measure their beta historically and divide by 1 plus the after-tax cost of debt, after-tax debt-to-equity ratio. That would be the beta if that firm had 0 debt. So now we have what we call it unlevered. That's a fancy word meaning no debt. A firm that has only equity, no debt. So now we have, all right, so this would be the beta of that coffee business if they had 0 debt. And then we can use that unlevered beta and say, well, what if you want to use this DDE ratio? So it's this process of delevering the beta to figure out what would be the beta if they had 0 debt, and then relevering it based on whatever DDE ratio you want to use. Does that make sense? So how am I going to use this for the Apple example? Yeah, I know that Apple has 90% equity and 10% debt. I'm going to take their beta, which is measured, say, the last 5 years of stock prices, and I'm going to delever it and say this would be the beta for Apple if they had no debt. But you know what? They want to finance this little mini iPad thing using not 90-10, they want to use 60-40. I'll just relever it based on 60-40. And that's how we count for differences in capital structure and debt. And then we'll just plug that new beta into our cap M. So here's the little example that we did a year ago. All right, so here is actually this is nothing different than what we already did. This is the 8.85, this is the 195, this is a negative 5 million. All right. This is using 90% equity and 10% debt. All right, so now the question is, what do we do if they want to finance the project differently? They want to use more debt and less equity, say 60-40 or 50-50. All right, so what we're going to do is we're just going to take the beta, delever it based on the 90-10, relever it based on the 60-40, but then we have to deal with the debt spread, how that changes. So here's the solution to this problem. Again, this is what we already did. This is the negative 5 million that was on the last 3 slides, except the only difference, the same project. It's the same project. However, they want to finance it 35% debt, 65% equity. So it's going to be a little riskier. Right? The financing is a little riskier. All right, so what do you think is going to happen to the beta when I'm done? Going to go up. What's going to happen to the cost of debt? Go up. So if you're getting debt on this new mini iPad project, it's riskier. It's got more debt. What's going to happen to the WACC? It's unclear. It's unclear. So that's what's confusing part, right? If you issue debt, cost of equity goes up because the stock's riskier. Cost of debt goes up because debt is riskier. However, you're shifting the percentage you're financing from the highest risky, or highest, where's my cost of equity here? Where's my WACC? Right. We're shifting your financing from equity to debt. Equity is a higher return than debt. So yeah, the cost of equity, debt has gone up. Yeah, the cost of equity has gone up, but you're shifting your financing from the high cost of capital area to the low cost of capital. So it's not clear how it's going to work.
Because your denominator goes up slightly, so you don't know what the portion side of the expenses is. Is that what you're saying? That yield, what's the actual?
Well, I guess I'm saying is is I'm going to take my percent equity times my cost of equity plus my percent debt times my after-tax cost of debt. All right, this is going up. This is going up. This is going down. This is going up. Yeah, is that okay? Just the percent equity is going down. Now what's key to this argument is this is greater than this. So you're shifting from equity to debt. But
You don't know the magnitude of.
But yeah, so you don't know until you actually work the numbers how it's going to work out. It's not obvious, right? If the WACC goes down, that was a good move. You're actually creating value for the firm. And how you're actually creating value is not a magic thing. The government subsidizes debt. So firms like to use debt versus equity because there's just basic tax preference for debt. So when we actually work out the numbers, the WACC goes from 885 to 834. So it actually paid off. Now you could claim, well, how do these finance weenies create value? Nothing. How can you just create value by changing financing? You didn't actually build a mini iPad. You don't know how the circuits work, right? All you engineers will tell me that, right? I created value as much as you figuring out how to create a circuit board that's smaller. All right. I figured out that because of the tax shield of debt, by shifting some of our financing from equity to debt, I can create value. And the project at this point kind of breaks even. It's close to breaking even. All right. So you can kind of wave your hand and say this is finance weenie stuff, but it's real. If I can find a cheaper way to finance a project, I can create value. Yeah.
So you have to change your whole capital structure?
It's just for this one project. Just for this one project. All right. Now let's talk about the cable business. So this is just kind of monkeying around with the debt structure, we call it the capital structure, how much debt versus equity you have. And sometimes you can create some value by just financing it a little bit differently. Then the other example that we did last year is, what if Apple wants to get into the cable business? Well, if you want to get in the cable business, that's a different set of risks than the tech gadget business. And their current debt holders and their current bond holder or equity holders, when we measure their cost of equity and cost of debt, that reflects the risk of that tech, not cable. So kind of back to Chris's question, how do you get a beta for a firm that doesn't have public stock? Well, in this case, Apple doesn't have public stock in cable, but they can just steal Comcast beta and say, well, we'll take Comcast beta, we'll de-lever it and show what Comcast beta would be if they had zero debt. Therefore, that beta simply reflects the risk of cable business and not the fact they have lots of debt. And then we'll just lever it based on whatever whatever capital structure, debt to equity ratio that they want to finance the project. And here's the example. You just go and look on the internet and you see that cable, whether it's an average of a bunch of cable companies or it's just Comcast, say Comcast beta is 1.05. That's Comcast. And you know that Comcast has a D to E of 0.3, and Comcast has a tax rate of 0.65. So you can say that Comcast, if they had zero debt, would have a beta of 0.879. That should reflect the risk of simply cable business, nothing about financing it. There's no financial risk in that number. Then Apple can take that number. This is legal. You can steal betas, all right? They'll take that number and, you know what, we're going to finance it using our 90-10 debt-to-equity ratio and say this is our beta for Apple financing a project in cable. And I'll plug that in my CAPM and that becomes my KE and I'm done. Plug it into my WACC. All right?
So that's using the same capital structure.
Using the same capital structure, but just a different business. And And here's one place to find unleveraged betas by industry. If you're interested, DeModern, Oswald DeModern, NYU keeps a data set of all unlevered. So he does the unlevering for you. So DeModern will actually just give you these numbers. Unlevered cable is this. He just does all the work of unlevering them for you. What's that? He's a nice guy. He's creating a big public good. All right, this is a summary I gave you last year. If a firm is looking, this is going to, all of you need to keep your ears open for this one because all of you at some point need to ask for money from some finance weenie who's underqualified to answer the question, so you need to be ready to go against them. If you think your project has zero risk, all right, I'm not launching a new business. I just want to buy a new copier at the headquarters in Apple. You shouldn't be using Apple's WACC, right? That's simply just buying a copier, right? So what you should probably use is something close to the risk-free rate, except for corporations, what they'll tend to do is just use their after-tax cost of debt and say, you know what, that's kind of risk-free for us. So if you are working in infrastructure, IT, and you're not directly related to the risk of the business, you should be arguing that your firm, when they apply the NPV to your project, uses the after-tax cost of debt, not the firm's WACC. If your little project is launching a new mini iPad, using the same debt structure as the firm, use the WACC. If your little iPad is in the same industry, but you're just going to use a little bit different DE ratio, just re-lever the WACC using the project's DD ratio. All right. If you're in the cable business, all right. If you're in the cable business, that's when you go and you steal Comcast beta and either lever it or don't lever it based on your capital structure. So that's kind of all there is. You're either risk-free or risky. And if you're risky, you actually have the firm's existing risk or they have some different risk, different industry risk. All right. Now the case for next week, AES, they have several different business lines and each business line has its own beta. But they also have different countries they're looking at. So they're trying to figure out, you have to kind of keep track of what is the industry they're looking to invest in and what country are they looking to invest in. All right, last couple slides. Yeah.
This came up in a sales training. Conference I was in with IBM's global finance team. And what they said was that we're selling IT or whatever it might be software to a firm talking about financing. Find out that firm's WACC to compare to their numbers. But what we're talking about now,
Selling IT to another firm.
yeah, let's say just $500 million worth of yeah. So in order to get the finance with IBM's global financing services, compare that those interest rates and such to what the firm would use to finance it on the outside or using their WACC.
So the company, so you have a leasing business.
It didn't make sense.
So you were able to finance your customers. You're able to finance your customer's purchase. And what you can basically tell them is your WACC is 9%. I'll give you an 8% loan. It's cheap. Is that what you're kind of saying?
That's one.
What's that?
That's one way, and then the other way is beating WACC, right?
What's that?
Beating the hurdle rate WACC if you're a DB on our project.
Well, there's two things going on there. One is just financing. Like, I'll give you a loan that's less than your WACC, therefore you must be better off. Which is by the same, I guess that's saying we're creating value. But if you finance it, it's going to cost you 9, I'll finance it 8.5, you're better off. I think that's what you're saying.
But are they really going to finance it at their WACC? Or should it?
Well, I mean, that's a really hard question. Because we don't even know how to calculate data. We're not sure what market's going to do. It's just our guess. So, yeah, in some sense it is an art, not science.
Yeah.
But is that fair comparison? Do you want to compare it to the WACC? Because they still have cost benefit, right? Even if they.
Yeah, that's the other kind of thought I had is you're giving them a piece of debt only, so why are you measuring against WACC? So, because the firm that's offering the financing, you get to trick them a little bit.
Yeah.
Right?
Oh, yeah, that's exactly
But
what
they still have that cost benefit.
Right. So it's brilliant marketing that I'll give you debt less than your WACC. Marketing guys just like. So really that's not fair because piece of debt is riskier than a mix of that. That's interesting.
You can just calculate that line. So now you're paying.
Really smart.
Interesting. That probably works on 99% of the people.
That was my second question. How many would buy it?
I don't know. That's a good question. I don't know. I would hope not. It's deceptive, though. All right.
I was looking at that NYU data.
So he has a beta and he's accomplished unlevered beta. Of course, you have like industry.
Yeah. So the unlevered beta is actually going right to the number you need right here. So he's already delevered all the individual firms in that industry and told you their beta.
So is that like an average?
So that's what you say, it's an average?
So if it's cable, he'll take the top 10 cable companies, actually delever every one of those companies by their DDE ratio, and then I think he does a market value weighted beta of all the firms. So if Comcast is half of the market cap of that industry, it gets half the weight. So it's a little smarter than that. So it's a market cap weighted beta of all the individual firms using all the individual firms' DDE ratios. I think that's what he does.
So this beta still has the debt to each of those companies working weighted average.
Yeah, so he's already done all that. So you get to start at this level here. You don't have to start here. You don't have to go here. All right. Last two things. How do we... Most projects don't die after 3 years. They go on forever. Right? So you expect mini iPads maybe to last forever. So how do you deal with the project that has an infinite life, or at least a really long life? Well, there's two solutions to that problem. Exit multiples or growth perpetuities. All right. Remember those? Those are kind of tricky. So the first one is if you're going to have an infinite life project, I'm going to take the first cash flow. I'm going to take the present value of the next X cash flows, or X n number of cash flows. However, at some point, I get to a level of cash flows and I say, okay, at that point, it's going to grow at this rate forever, and I'm just going to stop it right there. And I'm just going to say, you know what, in 5 years, it's going to grow at 5% forever, so I'm going to take that year 5 cash flow, divide it by my discount rate minus my perpetual growth rate. If this is the cash flow in year 5, and I divide by K minus G, it actually gives me the value in year, does anyone remember this? 4. And then I'm going to discount it back 4 more years to take it back to time period 0. I'll show you an example in a minute. So that's one way of estimating the value of infinite series. It's just by assuming a constant growth rate, you can calculate the value of that infinite series. The second way to do it, and we're going to show 2 examples, is when you get to this stage here, you usually have some kind of metric called an exit multiple or a cash flow multiple or an EBITDA multiple. And you say, you know what, the average firm in our business sells for about 10 times cash flows. 5 years from now, this project's going to be roughly average growth. So the value of that project 5 years from now is just 10 times the value of the cash flows. So if you say 10 times cash flow, and you discount that back to the present, and you're done. So let's just show 2 examples, take a little mini break, and then we'll do international projects. All right, Facebook is going to do a new venture. It's going to spend $900 today, get $100 next year. That $100 is going to grow by 15% in year 2. It's going to grow by another 15% in year 3. In year 4, it's going to grow by another 15%, and then, another 3%. So these are the cash flows 4 years from now. So 100% grew by 15 in year 2, grew by 15 in year 3, and then grew by 3% in year 4. So now this is my year 4 cash flow. That's my free cash flow in year 4. Then that cash flow is going to grow at 3% forever, meaning the end of time, farther than the end of time, right? So to calculate the value of that infinite series, I'll just take that cash flow in year 4 over the discount rate minus the infinite growth rate. That'll give me the cash flow, the value of the cash flow, not in year 4, but in year 3. So I just need to discount it back 3 more years. And that'll give me the present value of that infinite series that starts in year 4. And when I add all that together, the NPV is positive. So that's I don't know which is more common. I see both of them, either infinite cash or infinite series or this cash flow multiple. You okay with this one? All right. Maybe we'll look at a couple examples at the end of this. And then the only other way to do this is to say, okay, we're going to just spend 900 today. We're going to get 100. The 100 is going to grow by 15%. It's going to grow by 15% again. Then it's going to grow by 3%. So all that's the same, okay? However, we're not going to assume an infinite cash flow growth perpetuity. We're just going to say, you know what? At that point, I think that project is worth 10 times the cash flow. That's kind of roughly where firms trade, 10 times their cash flows. So 10 times this number is what it's worth 4 years from now. Therefore, I'll just discount it back for 4 years, and I get a different valuation. This is, again, I'm not sure which is more common. I think this might be more common, but I'm not sure. And they generally use EBITDA multiples and not cash flow multiples, but that's a very minor point. And that's how you calculate NPVs.
Does this one always give a lower number?
No. It's really the value, if I made this 15, it will give a higher value. So it's really just a trade-off between what is the exact infinite growth you're assuming and what's the multiple. A lot of people think this is the safest way to do it because it's not so sensitive to being, say, 2.5% infinite growth versus 4% infinite growth. And most people can wrap their heads around firms in my industry trade for about 10 times cash flows. That's kind of a metric most people know in their industry, whether that's 5, 7, 10, or 15, kind of in that range. So most people kind of feel more comfortable with this one versus making an assumption of growth forever. All right, so back to you. You want to get your project green-lighted because you want your job to last forever, right? So what are you going to argue for? You're going to argue for a low discount rate because it's really a risk-free project, people. Let's use the after-tax cost of debt. All right. And when they go to value it, you want a really high multiple. Oh, this is a valuable project. It's worth 10 times cash flows. Or those savings, they could grow at 5% forever. So you kind of argue for that these cash flows are more valuable in the future. All right. So that is our 24 hours of classes last year. Feel good about that? Yeah.
In 1 hour.
In 1 hour.
10 out of 15, right?
Yeah.
So how do you that the amount of growth?
Does anyone do a lot of acquisitions in their firm? Like look at other firms? Do you have a metric you use?
So
What's your industry and what's your metric?
So it's pharmaceutical. So for the consumer, we use the first one, actual.
Yeah.
And then the metric usually, to analyze a deal is basically doing free cash flow.
So you use broker too?
Yeah.
Does anyone use a multiple? We use just even. Even at multiple? And what is it? So what's the range?
Between 6 and 20.
6 and 20? All right, so one way of doing it is kind of plug into your industry and see deals every day. Oh, this firm just got bought, this firm got bought. You see the price, you see the people, and you know that they seem to be trading, or the firms seem to be valued at 10 to 12 times even, or 10 to 12 times cash flow for close to that. So I think it's based on your industry. Why some has to have a 20 and maybe it's a higher growth industry. That help? So you just look at a bunch of deals recently in your industry and see if they trade at. This firm was just bought for 10 times EBITDA, this one was just bought
6.
This one looks more like this one. I think a normal rate would probably be more like 6 to 12.
Because it's in merchant services, so some of the portfolio is like one portfolio that's a taxi business, which is a crush and Uber. So that's something you can have 6.
So they gotta love it.
Well, so I guess just, so not from maybe an acquisition level, but individual project, right? So you're trying to justify the project.
Yeah, so it's just like buying a copier for the headquarters, you probably can't do that. And also it's buying that into the block either, so it's like, you probably can't do that. So this is more buying ongoing concerns, or investing in ongoing concerns.
So is this saying that you're gonna get out of this investment after year 4?
This pretends if you sold the entire business for 10 or 15 times cash flows in year 4. So it doesn't mean it ends, it means you sold it to someone else that holds it forever.
Yeah.
So the project doesn't end, you just sold it to someone. Somebody paid for it. It's almost like a private equity type model. I'm going to buy it, I'm going to goose up the EBITDA for about 5 years and hopefully sell it for 10, 15 times EBITDA 5 years from now. This is what the PE firms do. That's the whole goal. My understanding of what PE firms do. You buy a firm, you improve the EBITDA, goose up the EBITDA by putting out some fat, and then try to sell it a nice fat EBITDA multiple 5 years from now. So they're both trying to increase that cash flow and trying to get the best multiple. So that's the way they kind of look at it, 3 to 5 years.
So the 241 is down on that last line. That's the
net present value of the project. So this project creates value for firms greater than 0. They should do. It's creating $241 of value. All that's going to improve the equity holders. So the stock price should go up in a minute. The rest of the world figure out there. That's the theory of what should happen. So if there's 100 shares outstanding in this firm, the stock price should go up by $2.41 that day. Like that's theoretical what should happen. You're creating value. Once the world figures that out, they're going to value your stock.
So it's not based off of the investment cost, it's based off of what the share cost.
Well, this one did have a cost of $900. So this actually is the creation of value. This is not buying another business. This is investing $900 today and getting these cash flows in the future. It's a little bit different than this. I could have reworded this. Facebook is looking at buying a business for $900 today, a private firm. They're going to generate these cash flows in the next few years and then sell it for 10 times cash flows a few years from now. This will be the same math. Versus Facebook is going to spend $900 today, generate these cash flows, and sell off the business for 10 times cash flows a few years from now. So you can use either story. That helpful?
Mm-hmm. So is that essentially like the ROI then out of this $900 million investment?
The ROI is always in percents. So it's almost like an IRR. ROI is like an IRR. This is $1. $241. Well, yeah, you create $241 in present value terms. It's like you just create $241 today on that. So your idea of this project, you just create $241 value.
And if you did have a range of multiples that Douglas thought might do a sensitivity analysis on that range.
Oh, I love it. Yeah. Oh, yeah, my little data table. Just we're going to do this. We're going to do
red on color.
Oh, it's going to be awesome. Yeah.
So the magnitude of this entire thing is that you spent 900 and we're back to 1141.
Sort of, yeah. In present value terms. You spend $900 today and you get all that back in present value terms. Yep. We good? All right, that's how us finance weenies run. All right, this is how we evaluate your projects. All right, so let's take a little break. We'll talk about why it's different if the project's in another country. Only two little things I have to deal with. It's really easy. I mean, it should take like 5 minutes, but I'll make it an hour. 2 little things. Some of those cash flows are in dollars, and some are dollars. I can convert everything back to dollars. That's step 1. Step 2 is India seems more risky than in Indiana. Shouldn't we have a different discount rate? Probably. We'll deal with that. Those are the only 2 things we have to do in the next hour, okay? So let's take what time we got? 3:22. What time? How much time you want? 15:37. I might be done early today. The way you guys are.
There he is.
Is that all right? Want me to stick around?
Hey, you know what, Lou? You're
Go.
okay. I don't care what they say about you. You're okay.
Every minute you get out earlier.
You get that much better. The questions I have that are in my office, I think it's something I'm interested in is my father and I are doing that'll be the capital for it be provided by his company, and it's. I guess what I'm trying to do is part of what we're actually Hamburg is trying to make this a reality too. That's Proxy tools we have here. And this goes more back to original finance, but it's more than the international global. But he's privately held by accident. And then you brought up the beta, and now it's starting to how you do that. But looking at that, it's difficult to. It's difficult with a small firm that has, a 35-year history, so I have to look at his performance over that period of time. But the other companies, what they do is very
Trying to value for us?
Yeah, because to figure out like a WACC, like if I'm trying to calculate like a WACC, to decide on this project, to show this project is worth doing, right? So, we're guesstimating everything, obviously, what we expect, revenues, and things like that. But basically, we can look and say, okay, this is how much it's going to cost us debt-wise. What's it going to cost us?
What industry?
It's lab automation, lab automation, genetic testing. It's a novel device that'll be rolled out more at the consumer and the hospital level versus where it is now, just research on academic institutions, things like that.
Is there an industry that you saw that was close?
Well, that's the thing. Like I was looking at Stern School, NYU Stern, things in beta that was 1.18 for drugs. Parentheses.
Let's go.
Right, because there was no. Then he had the lever data. That was 1.08, I think, or something like that. I might be making that up. I think it was 1.18 was the data.
I gotta get rid of this.
And then
Hey, what are you guys doing?
I looked at a bunch of companies that my
I want to get rid of this.
most of them are much better.
Show me the
No, seriously. No, where are the bodies?
So what he does would be a division of those. Segment. But is that right to use it?
Oh, you're on your watch.
See how it's like.
He's more of a niche kind of, mix of robotics. And there are companies that do similar things.
Well, here's also a trick to get you out of the whole capital structure thing. There's a school of thought that says, forget about the capital structure, forget about the cost of debt, forget about the tax. Just pretend the firm has no debt. Just get cost of capital that way. And just say, so basically, you can just plug this into, I'd use, say, the 10-year treasury. It's about 2.5. Plus 1.5. Four to 6%.
Okay. Oh, right.
Let's say 5%. So what is that? 5.5 plus 2.5. 8. Yeah, so I mean, and maybe that's kind of a point of reference. The way of thinking about this, you're basically saying it's about the average risk of the S&P 500. We're no riskier or safer than other firms in the S&P 500. Therefore, this maybe sounds right.
What if that may have been explained? Like he's survived all his recessions.
Well, also probably has almost no debt.
He has a pretty significant credit.
Okay, that he uses a lot. Yeah. Okay, so, but I mean, this could be a benchmark. Because time you have to kind of make up the cost of debt, the tax rate, the percentages. Some people say it's not worth the risk. Just saying, just pretend the financing doesn't really create much value. So let's just go with the kind of unlevered way of plugging cat down. So that's just one way of thinking about it. The way you can do that is you can maybe do an average of a bunch of industries. we are viewed like just a tech, one of those tech categories. Maybe that is like 1.3, but maybe we are kind of considered more of a farm hub, where it's maybe 0.9. So you can kind of have a range.
I fear a negative NPV.
And you
negative
what?
one.
What do you mean?
Like in determining whether we're going to do this project, right?
So you're just considering whether to do this project.
Yeah.
Or
Yeah.
You have to come up with some kind of R&D or initial CapEx.
Yeah, trying to figure out, like, you can do it, but I mean, like, because in reality, this is all theoretical. It's all kind of guessing, but it's hedging. It's saying, probably going to be fine. But if it's negative, it might not be. Like, that's
Well,
what
here's, I mean, I would maybe get out of that work. Get out of there's so much uncertainty here. Just calculate IRR. And if the IRR is 6 or 9, just say, is it 6% worth risk?
Right.
Right. And so you kind of have this fuzzy notion that I think I should get 7 or 8 or something, but what's funny is like sometimes the IRR is 20%. Like you didn't have to work, you shouldn't have ever wasted your time, whether it was 5.5 or 5.8 or 7.1. It's 19.
That's what I ended up doing for Alvisser's paper, was I did the IRR. And I wrote, because there's no public equity, I'll just go straight to that. But then,
but the answer is like, if it's 19, any range I get of WACC, it's going to be positive.
right. Yeah, that's
But if I get 3, any range I get of WACC, it's going to be negative. So, you almost have like, as a first step, just look at the cash flows and calculate a quick IRR. And if it's above 10 or below 3, the answer is done. Like, don't wait. Just that number, interesting to know what it is, but it's done. I'm not going to do it. I'm going to do it. So you have like this range of 5 to 9 is do it, don't do it. In here, oh my God, no,
they're going to do that, right?
Yeah.
So it's above this.
Right. So maybe that's the better way to do it. A lot of times they are.
How do you even determine this? Well, you know what I mean?
You can make a case that bioengineering can't be much, probably less than an average risk.
Right.
So somewhere 0.9 to 1 or 1.1, that's got to be the lower range.
Right.
Or maybe plug that in with like a really low. So maybe this is your lowest possible WACC, where this is probably the lowest value and this is probably the lowest value. So 6.5 is kind of your minimum. Then like, well, all right, well maybe this is 6. Maybe this is 1.3.
Right.
So 1.8. So maybe that becomes kind of. But a lot of times the cash flows, they are. I mean, why would they be that close? A lot of times those IRRs are 20, 30, 40%, or negative 20, 20, 40%. So maybe just start there. And if you had to get to this point, it's more like, okay, the number turns out to be 8.1. I mean, you could do this work to figure out the exact, we're going to say we're not dead. It's worth doing this. 8.1%.
Right. I think the upside's going to be much bigger.
So don't worry about the WACC. Focus on the cash flows first. Calculate the IRR.
Okay.
If it's close,
I'll write this down before I forget.
All right. Does that help a little bit?
Yes, it helps a lot.
All right.
And it's kind of the way I was going with it. Like for that paper I wrote, and I didn't have it down to this kind of. I was kind of spitballing it.
Yeah.
So this is a much finer example. Thank you.
Sure.
Chris and Doug, these chairs.
Modern formula.
You don't want to play football.
It's too dangerous.
Let me tell you, we play football in the yard, you know, like at his mom's house. So he's my uncle's son, and my mother's brother that he died. And yeah, he's tall, dude. He got all the good genes in the family. He's 6'5", 6'6". Yeah, he could throw that damn ball. He could really throw and kick too. You know, he punts, man. It's just crazy. We'll come out to the beach tomorrow, Wayne? I'm thinking about going, man.
Might have to ask permission.
Yeah?
No, I got a road trip tomorrow. Just
11 o'clock.
I don't want to remember. I got a road trip tomorrow.
Oh, yeah?
Yeah.
Yeah.
One hotel.
You know, my wife wakes up for church in the morning.
Saturday afternoon. I can't wait to get these back.
What's that, the test?
Huh?
Saturday.
Saturdays.
Oh, Saturday. I said these
Yes.
grades or something? I'm not even thinking about that.
Hey Chris, have you guys ever run the Philly Broad Street run?
What's
It's a
Oh, the
Broad
Broad
Street run.
That's
Yeah.
like that's a half.
The half or yeah.
I have
Oh no, 10K.
10K. Yeah, I have it.
I heard the Broad Street runs just like
Half.
half of the marathon.
It's 10K.
Oh, yeah, now, right?
We used to have a big 10K in Richmond. It was like 40 or 50,000 people with they had bands in the middle, like where they would run. So we run like up and then come back. And you say the Broad Street one's kind of like Philly.
There's an early in Allentown when they did all time players, the rock and roll hat.
Yeah, that's another one. Yeah.
Are you thinking about writing it?
Yeah. Thank you, Shane. Expect up.
10K is perfect, man.
Yeah.
What's that like?
Now the wife's not pregnant anymore. Now we can both go get her out. She wants to do it.
How much is it?
I don't know. She said it gets pretty packed though, supposedly. So she told me to just ask you guys what you think of it.
Oh, Brielle, 10K this weekend.
No, I'm sure it's fun. Broad Street is flat.
Yeah.
If they're probably starting on the thing from like City Hall, and straight down, and 6.5 miles.
Yeah,
Most of
loop.
it is 6.2, whatever it is.
Yes.
And they renovated a lot of Broad Street. It used to be a lot like
Potholes.
no, I'm talking about like it just used to be like real ghetto.
Oh yeah.
And then because of Temple and all the universities, it started expanding out. So they renovated a lot of buildings. It's nicer. Yeah. I'm sure it's a nice one.
You know, the shore, man, one was 5 mile run, still 5K. Except for the spring wave, that's still, it's a surprise one.
Oh, really?
Yeah, you see all the swing African guys, come up, and he's they're all front line. They're all running, they look at the 10, 15, drag, whatever it is. Wow. Smart. See you in marathon? New York. My brother ran New York, the same guy ran Philly. And these guys, they're mile 22s. They run it, like Johnny runs like 5K. I never ran 5Ks. I do it for sure. Wake up early, go swim. This is racing more jerseys now. This is racing more jerseys. And we got a year from that January. It's $10 and worse place ever.
What?
Worse place ever.
Really?
Yeah, the trails are deer trails.
Oh, yeah.
Deer trails. And it's not paved or anything. So you need rocks anymore. So it's just, you can't run it real hard or anything. It's just a place for you to just rank it up there.
How many months we have left, guys? 6?
Yes. Until May.
8 months.
But it looks like class-wise, we only have
Like 6 months of class. I heard 7 months.
4 classes and then the global learning. Oh shit, never mind.
Again, shape
I just
global
go
version.
Fuck that, we got like 4, 5, 6, 7, 8, 9, 10, 11, 12. 4 more classes, including global learning.
Oh, yeah, buddy.
Supply chain for C-suites is a 3 credit, and business plan is a 3 credit. Everything else is 1 credit.
Oh, sure. We got like
You guys look at that. They had the artificial intelligence seminar this week. The guy showed a Chinese sword, and the machines are going to cut through a keyboard. The machine went like that, slice right through. That's how accurate their stance are. Artificial intelligence.
We want to put a sword in the.
Well, that's what they're saying.
But at the war, before you go, it's going to be like Skynet.
When you lose, in the plots.
Yeah, first the sword and second.
Then a machine gun.
You go to the gun shows, right?
It's like,
You know, like the Sig Blues or whatever.
Chris, did you see the movie A Small Sense?
Assassin?
Yeah.
Yeah, this is the one based on the video game.
Is it good?
I don't know, man. It was it's a version.
Oh, I hate that you can create that idea there, because then people start getting antsy. And then they start hating people that ask questions. It's like, shut up! Oh, I guess I should turn this up.
Getting cold?
It's really, really good.
Is it?
Yeah.